Welcome to Markets Now. I'm Michelle Roque with Mike Zuzulo, Global Commodity Analytics. Grain trade and livestock futures all to the plus side on Monday. And Mike, let's talk about kind of what pushed the grains here on a Monday. Was it all weather putting risk premium back in?
I really think it was, Michelle. I think the most part, we were looking at a global weather situation going home over the weekend, especially in Ukraine and the Black Sea regions. They were supposed to get some rains. They did, but it was very light rains from what I could tell. And when I look at some of the subscriptions that I buy when it comes to the soil moisture profiles now versus 5, 6 days from now, both Ukraine and Western Russia, Central Russia, as you would call it in the crop production maps, look like they're actually going to lose soil moisture over the next 5 to 6 days. And I think that really took the market by a little bit of surprise. And I think we saw that in the fact that the canola market, the ICE canola futures up around 4% on the session. Ukraine was, I think, a highlight, as was the Canadian prairies, southern Saskatchewan in particular. That was already being looked at on Friday. Some reports already talking about heat blast in their canola crop. So I think those oil seeds, rapeseed and canola seed, really helped the soybean complex out on Monday and give us that short covering rally.
So let's talk about how much risk premium you think the markets will put back in here, especially with what you just said. The funds are short. They're near to record short in all of the grains on the Commitment to Traders report. So how much do they cover?
I think this is going to be the tough part, because if we have a weather market and it's global, not supply, and we have the global prices like Ukrainian corn, Brazilian corn, Argentine soybeans, and some of these other key global prices in the cash market start to go higher, I think the trade will have more confidence that a rising tide lifts all boats. Wheat, corn, and beans try to go up together. But we need to watch for the fact that what happened on Monday was the corn was a little bit tardy on the rally, waited until the close before getting back up above that June 28th acreage stocks report close of around 395, 398 level. We did get a close above that in September futures. That could be presenting a buy signal on the charts technically. So I think one of the things that we really got to watch is how much does the wheat participate in. The more it participates in, the more we'll get the outside markets to help us, and then that gives us more upside. So a gap in August beans, in other words, the lead month weekly chart, when July went off the board around 1135, can't exclude that being a possibility. And if we continue with a weaker dollar, stronger wheat market, and we see those macro fundamentals support us, I could see another 5, 10, maybe even 15% rally because of just the net move we've had to the downside. And so the big thing that I'm going to be watching supply side is with the global supplies. I think wheat and corn global supplies are much tighter than the soybean global supplies. So at some point, I'm going to say to clients and subscribers, let's get back on the hedge train with the soybeans, maybe let the corn go a little bit longer.
You mentioned the outside markets. Let's talk about, we had a lot of news in the news cycle over the week, and the Red Sea war kind of erupted again here. You had what happened with President Biden pulling out of the presidential race. Did any of these things have an influence on the market on Monday?
I think so. And I think that the trade was stumbling more on Monday. And I think before we had the weekend news of President Biden leaving the race, we had started to develop more of a weaker bias in both the U.S. stocks and U.S. dollar. I think that makes sense. We have been on a tear in both the dollar and the U.S. equities for the idea that the U.S. was the strongest, it was the safest, it was the best game in town. I'm not so sure geopolitically we can say that now with the disruption that we've seen in both in what happened in Pennsylvania and now what's happened with President Biden leaving the race. And so I would be watching very carefully for additional selling in the dollar. And this goes back to the Chinese interest rate cuts that we saw on Monday morning as well. The first thing we should be looking at there is the Chinese currency firming and strengthening, not weakening. And it did weaken after that news came out.
Yeah. Obviously at first glance, you would look at those cuts in China on interest rates, and the idea would come into mind, hey, we're going to maybe get some export business as a result of that. You don't think that's going to happen, though?
No, I don't. I think the Chinese are really sitting on their hands when it comes to U.S. product. I think it's going to have to be a currency or a competitor supply situation that drives them to the U.S. And I think there was just brand new data that came out late Monday before the close that showed China's January through June imports of Brazil up 16% in volume from the United States. It was down 27%. They have been clearly choosing anywhere but the United States for most of their agriculture commodities. And I think this is what the funds have gotten right when it comes to why they're so net short right now. The more sanctions we put on, that typically adds to trade frictions, which typically adds to buying the dollar. I'm hoping now we can get to a point where we can unwind some of this, though.
Do you think we're down to a point, or we got down to a point with some of these contract lows in the grains where we stimulated some demand? Is it a value for end users as well?
I really think so, but we didn't see that on the weekly export inspections, and especially in the corn market. Michelle, you raise a huge point. For me, the corn market wants to go higher because of the supply-demand fundamentals globally. Even with the increase in the U.S. crop of 6 million metric tons this past month by USDA, we still didn't really move the dial when it came to ending stocks or stocks to use ratios. And I think between Europe, the Black Sea, and Brazil, we could more than offset that 6 million ton increase in the United States that the USDA gave us. And so I really think this is a situation where the corn demand starts to come on. We did get some Mexico business on Monday, but if we start to
Right.
see that export demand come on a little bit better, then I think we could see the corn actually lead this market. And I'm going to be looking for the beans, as I said a minute ago, maybe as the leader to the downside at some point, because South America, I think, has the soybeans. I don't think they have the corn, though.
Yeah, it looks like that when you look at basis levels, right?
Exactly right. And I think that's
Mhm.
another key element to the September corn is what does it look like as we go into delivery here in the not too distant future.
Right. Okay, cattle market. We got a boost on the placements number in the cattle on feed down 7%. Can we build on it, you think?
I think we can. I mean, we don't have the demand structure that we had before. Seasonally, we don't after July 4th. Retail featuring is down. I think USDA put it down almost 8% this past week on their update. But I would also say those 93% placement numbers for June really helped offset the May number. And got to wonder whether some of the June numbers or some of the June cattle placements didn't get snuck into the May report. And I think between that and this huge premium still in negotiated cash cattle, $10+ those two things, and maybe a little bit of heat coming back into Garden City, Kansas, and Amarillo, Texas here, maybe taking the weights down a bit. Those three things I think are worthy of the fat cattle market trying to go up another leg.
Yeah, we really haven't traded weather there at all in the cattle market for sure. And what about hogs? A cash and cutout values have seemingly improved. So it looks like the bottom might be in here, Mike, but can we keep going here? Do we have enough, I guess, gas in the tank?
Yeah, I think that's a great question to ask because we have got that BLT seasonal moving. The bellies leading the overall cutout up. We've had the Chinese market rally really nicely, but there can be an end to that Chinese market rally. And I would say, roughly speaking, Michelle, by the second week of August, if I get another move up in the deferred hogs, I'd probably want to really start to think about hedging the fourth quarter marketings as we get to like the 10th or 15th of August.
All right. Anything else that you're watching, Mike?
I think the big thing to watch here is the separation potentially between the corn and the soybeans after the initial weather rally, because a lot of people don't see a lot of upside potential in the corn. I'm very much a contrarian there.
All right. A lot of people are saying that though, because they think yields are going up, not down, right?
Exactly. And I talked about that with a really good colleague in Chicago on Friday, and I think that's actually mostly baked into the market price at this point.
Okay, let's hope $4 can hold here for a while in that December corn futures. All right, thanks for joining us, Mike Zuzulo, Global Commodity Analytics. That's Markets Now.